NNN Stock, ticker symbol NNN or triple N. This stock is down 25% year to date, underperforming the overall market big time. On the 2nd of August, triple N presented quarter results where they beat on FFO but missed on revenue. For the upcoming earnings, analysts think they will miss. And people love triple N stock because of multiple reasons, one of them being the dividend, and I understand why, with dividend yield at 6.5% and 32 years of dividend increases. So could this be the perfect moment to buy triple N stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does triple N do? Triple N is a real estate investment trust that invests in develops properties throughout the United States. The company generates revenue from leasing property to tenants, including convenience stores, automotive services, fitness centers, theaters, restaurants, and banks. If we dive in the most recent earnings report, we see that revenue was reported at $202 million, up from $190 million last year. So to me, this looks pretty good. Net earnings is up from $74 million last year to $98 million this year. Net earnings per share is also up a significant amount from $0.42 to $0.54. Both are looking really good to me. However, the most important numbers, FFO and AFFO, are looking a bit more disappointing. It is increasing but at a much slower rate, so this is something to keep your eye on. In this graph we see the historical occupancy rate, and to be honest, it is looking rock solid, at an average of 98.2% and never below 96%. Right now it is also looking really good. A thing that caught my eye was the acquisition volume. They tend to focus on quality over quantity, as they stated themselves in the presentation. But this leads to lower number of acquisitions, which also is something to keep your eye on. The company has a BBB plus and BAA rating, which is good, but I prefer A ratings here, to be honest. The current net debt to EBITDA is sitting at 5.5, which is a great number. This is really important to me and is looking good. They have been paying dividends for 34 consecutive years, making them the third longest of all public REITs and 97% of the NISE listed companies. Very impressive. NNN REIT is very diversified with almost 3,500 properties and 385 tenants. The geolocation is also looking really good. The WALT, short for weighted average lease term, is sitting at 10.2 years and only 3.3% expires through 2024, which is looking good to me. In here we see that convenience stores is the biggest industry with 16.9%, which is a significant amount. Automotive is second with 14.5%. The top 20 tenants also look pretty decent with some big names in there, and the biggest tenant representing 4.6% of the portfolio. I prefer this number under the 5%, so it's looking good. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Triple N is a 6.3 billion market cap company. PE ratio is not a fair metric to use with REITs, so I will be using the price to FFO instead. Right now it is sitting at 10.96, indicating they might be undervalued. Later in this video I will show you my 3 price targets for triple N stocks, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at $798 million, and in this graph we see that revenue went up in the long run. During the lockdown periods there was a small decrease. We see that margins are increasing again, which is something that I really like. EPS is following the same pattern, so again this looks really good to me. Analysts expect mid-single digit EPS growth in the coming years, nothing special to mention here. And for the revenue it is a pretty similar story. It's expected to grow at mid-single digits in the future. Return on assets is sitting at 6.5%, which is a decent number for a REIT. Return on equity looks good, and the most important number, return on invested capital, is sitting at 4.1%, which is a low number. But it is slightly higher than the 5-year average, so that's very nice. Current ratio is at 1.45, which is a great number for a REIT. Historically, this number goes up and down big time. Right now, NNN has 4 billion in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. NNN has 2 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 6.5%, which is a great number. Annual payout is at $2.26 and payout ratio is at 69%, which is below the average for REITs. The 5-year growth rate is at almost 3%, which isn't the highest of course, but dividend yield is already pretty high and they have been increasing the dividends for 32 years in a row. So to me, this looks really good. In here we see the dividends paid since 2012. It is increasing at a slow rate, but again, over time this really adds up. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at historical levels, which is very nice. Overall the dividends look really good to me, but how about the historical returns? I decided to compare NNN stock with the overall market, in this case the S&P 500. Next to that I added FRT and ADC. On the 5-year chart we see that NNN underperformed the S&P 500 big time, with a minus 3.5% return including dividends. The S&P 500 did beat all stocks in this list by a decent amount. On the 1-year chart it looks pretty similar, with NNN sitting at minus 9% return. The S&P 500 is still beating all stocks in this list with a 13% return. On the 6-month chart it is again the S&P 500 that beats all stocks in this list. Everyone is sitting at a negative return besides the S&P 500. On the 1-month chart we see that all stocks and the S&P 500 are at a negative return, but again you are better off owning the S&P 500. So bottom line, NNN underperformed the S&P 500 short term and long term, but with the stock hammered down quite a lot it could be an interesting buying opportunity. So could this be the perfect time to buy NNN stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 4, 5 and 6%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 44, 46 and 48%, and for the free cash flow margin I'm putting in 73, 75 and 77%. For the PE ratio I'm also putting in 20, and for the price to free cash flow I'm putting in 10, 11 and 12. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want to build in a higher margin of safety here. Right now NNN stock is at $34.8. I hit analyze and we see a lot of red numbers. And since this is a REIT I'm only focusing on the discounted cash flow value. We have a low price target of $29, which is a decent drop from the current stock price. We have a mid price target of roughly $34 and we have a high price target of roughly $38. To me, the mid to high price target is the most justified here, indicating that this stock could be undervalued. My final conclusion on this stock is that we got a steady and consistent company here. They have been increasing the dividends for a long time and all other growth numbers are looking pretty decent. No big numbers, but consistency is the word here. From a dividend point of view, things look really good. You got a strong dividend payer with historical track record that beats most other stocks. From a value point of view, things don't look bad either. But the only downside is, in the past 5 years the stock has been massively underperforming the S&P 500, which concerns me a bit. It doesn't tell you much about the future of course, but it paints the image a little bit. Even with the stock being undervalued according to these numbers, I think there are better deals out there, so I'm putting them on my watch list and keep analyzing them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.